Good afternoon, everyone. My name is Robin Dolezal. With me, as always, is Alex Pars and Dan Nentel. Today is Wednesday, May 11th. How are you, gentlemen?
Good. How are you?
Doing very well. I apologize. I can already hear the echo in this room. The kids had an early release today, so I'm at the house, and of course we're moving. So now there's nothing in this room to isolate some of this noise. Anyway, how's your guys' day going?
Good.
So I know we just did this, guys. We met, 7 or 10 days ago, right before the Fed meeting. But we've got a lot of emails, phone calls, people calling us, wondering what the heck is going on with the market, because the market is still very volatile. Some people are wondering if they should be selling everything. And the answer is obviously no. It's actually a great time to buy. So let's talk a little bit more about that. And Dan, let's just start with you. Tell us a little bit of thoughts on what's going on in the market, even over the last 10 days or however you want to phrase it.
Well, I guess we've been saying this since, since the pandemic, since 2020. You flow with the Fed, you don't panic, the Fed's got our back, et cetera. Well, right now, the Fed is still the driving factor, but it's what happens with the inflationary numbers. So we had some inflation numbers come up today that, the analysts were hoping for a little bit, 0.1% less than it came out, and that caused the market to panic. The market was doing pretty well because it was less. Inflation actually decreased from March into April, so that's good news. Many people have said that we think April's number is the highest we're going to see, but the problem is we're not going to see a true recovery in the market until we know what the Fed and how quickly they're going to raise interest rates, et cetera. So I'm looking at the TV right now. They've got the Fed director from St. Louis Fed talking. That's really driving the market. Today was a bad day. We've had a bad week, which obviously dovetails into why, as you mentioned, we've received emails, we've received calls as to, is it time to go to cash? And absolutely not. I mean, the market has a big disconnect right now. Here's a perfect example. I was listening to a radio program this morning. Volkswagen is a fairly large international European company, and right now its market cap is 88 billion euros. Now, Volkswagen's a big holding company. They own Lamborghini, Audi, Porsche, Ducati, as well as Volkswagen. Their biggest profit margin company is Porsche. I didn't know that until reading that today, but they're actually going to sell Porsche. They're going to maintain ownership, but they're going to put it on the publicly traded market, do what they call an IPO, initial public offering. The estimate, now remember, all those car companies combined are worth 88 billion euros. Again, smaller than what Tesla's worth. Again, doesn't make sense. 88 billion euros. The estimate on when Porsche goes public, it's going to sell for, and when it opens, 80 billion euros. So hold it. Why isn't the company worth 190 billion euros if that's the case? There's just a disconnect right now. I think one of you guys are going to talk about pricing, but the disconnect right now, the fear mongering, the articles that you see out there, inflation's scary. Inflation is on the slowdown. It's going to be a while. We definitely need the supply chain to ease up. We need to know what's going on with Russia and Ukraine. But we know this. Inflation's on the way down. Everybody's talking about we're probably near, not at, but near a bottom in the market. And so we need to think about when we're going to deploy more of our assets back into the stock market. So am I panicked? Not at all. Is it frustrating? Absolutely.
It's funny. Every time we mention Tesla, I see Alex's face smirk.
So Alex,
since our last time that the Fed came out, but that was right after we spoke. So tell everybody what the Fed decided and your thoughts on that.
Well, the Fed did exactly what we thought they would, which is a 0.5 point raise, and then that they're going to start reducing their balance sheet. And they had mentioned a $95 billion per month number, and they're going to work their way up to that, I think, in September. So I think they were starting with 50 billion a month, which is actually a little bit more dovish than I expected. But all in all, in line with expectations. So the stock market reacted favorably to that for all of a day.
Right.
And then the fear mongering came back in. And what's the overriding thing that you need to remind yourself about right now is the big problem that we have is that the economy is too strong. Okay, that's the problem. And it's so strong that we can't keep stuff on shelves. and we can't find enough workers. It's, any business owner you talk to is lamenting the fact that they don't have enough product or they don't have enough people to move the product. This is not, close to a recession like every other article would have you believe. Yes, GDP went down last quarter through some basic accounting fluke, and maybe that accounting fluke, happens again. But does that put us in what I would consider a real recession? No. I mean, when I think of recession, I think of I'm worried about my next paycheck. How am I going to pay my mortgage? How am I going to pay my bills? 4.5 million people, again, quit their jobs last month to get a better one. Okay, now better means what? Maybe it's better lifestyle, but chances are it's better money. Okay, now downside is that contributes to inflation, but the upside is those people are not one bit worried about paying their bills. So what we've got going on right now is a lot of fear mongering. A couple of very interesting articles came out earlier this week. So, people did a study. All those people who are day trading and the meme stocks, the Reddit stocks, all the gains that they've gotten from 2020 up till now have been completely erased in the aggregate. Obviously, there's going to be some winners and some losers, but all their gains were gone as of last week. Now, I don't know if you follow the trending tickers, but this week has been a continued bloodbath for those, what I would call meme stocks, or stocks that really never had any intrinsic value. So another factor that's interesting is taxes. Capital gain taxes last year were about 4 times normal because of all the trading activity. So these people, not only did they lose their gains, they had to pay taxes. They probably spent some of that. Bottom line is the retail trader that was controlling the market last year is probably pretty much out of the markets. Now, that's a good thing for the stock market as a whole, because we were in real danger of having what I would call another Y2K moment, where we had tech stocks blowing up and the whole market got dragged down. What was it, 49, 51% for the S&P? Okay,
Yep.
Right now, the S&P is down what, Dan?
27.5.
Not the S&P, that's the NASDAQ.
I'm sorry, 17.5.
17.5%. So it's doing poorly, but it's not, getting crushed like the 2002. Now, again, the good news is that those stocks, they're down 90%, 75%. So there's not much more room for those things to fall and affect the broader markets. So the broader market as a whole is actually pretty healthy. We've got year-over-year profit growth as of this last quarter of about 7.7%. 80% of companies reporting above estimates, which means better profits than expected. And I'm going to come back to my, my sweater story, which is if you go to Macy's, Robin hates this story. You go to Macy's, you find a sweater, it's $100, and you say, I'm going to think about that. I'll come back tomorrow. It seems a little expensive. You go home, you sleep on it, and you decide, you know what? That's a good value. I'm going to go get it. And you get to the store, and now it's 27% off. Okay. Do you run screaming saying, oh my gosh, this is a terrible deal now. I don't want this sweater. No, it's a better deal. The companies in the market are stronger than they were a month ago. They've got more profits than they had a year ago, and their price is lower. Okay. That makes it a buying opportunity. The economy is very, very strong. As Dan said, is this the bottom? Who knows? But I can tell you the NASDAQ's 27% cheaper than it was at the beginning of the year. So that's a deal. Okay, the S&P 18% cheaper. That's a deal. So we've been somewhat isolated from these, these horrific numbers because we've had more value stocks, but we're starting to creep in and look at, some opportunities in the growth sectors as the pricing gets more in line. Okay.
So talk to us about the pricing, because we were before this we were talking about PE ratios. What are some of the PE ratios that we were referencing?
Yeah, so at the beginning of the year, around the peak, the NASDAQ was around 40 times. Now they're probably 22, 23 times. So profits have come up like we talked about, and the prices declined significantly. So we're looking at a significantly better deal from a PE ratio perspective. Value stocks are probably 16, 17 times trailing earnings, and the S&P is probably around 19. So again, if you look at forward earnings, those numbers look even better. We're probably looking at, 16 times value, 17 times growth or S&P, and maybe 19 or 20 times NASDAQ. So, and smalls and mids are 12, 13 in forward earnings. So much, much better PE ratios. Those numbers are kind of, they're like numbers we haven't seen since 2013, right after the Great Recession and companies came back online. So right now, the market has been driven down far enough that it's actually a good deal. I was joking last year when people said, I don't want to buy the markets. It's too expensive. You remember talking about this, like just close your eyes, hold your nose and buy, right? That's not the case anymore. Now things are a decent price. It's not a great price, but it's a decent price. You can actually buy saying this is a good value.
Well, and one thing to keep in mind though is there's a lot of things that are a good value based on pricing. Doesn't mean they actually are a good value that you should be buying. You have to remember that the PE ratio is price over earnings. Key component is earnings. So you look at Bitcoin. Bitcoin is down 60% from its peak of 2021, down about 38% year to date. What kind of earnings does Bitcoin have? None. So there's no way to know if that's a good price or not. Was it a good price at 14,000 just three years ago? Was it a good price last year at 60,000? There's no way to know. But if you look at actual stocks that are publicly traded, that they have to report their earnings, we can say prices here, earnings are here. If it's too big of a spread, it's overpriced. Right now, the pricing seems very attractive, which is why you're seeing a lot more people talking about we're probably not at the bottom, we're getting closer because the pricing seems reasonable. It didn't seem reasonable entering 2022.
Yeah.
Well, and we're now entering our summer months, so expect some more volatility, right?
I'm not sure you can get more volatility than the last 2 weeks.
Right. Expect more continued volatility, I guess is what I should have said.
And this really is an opportunity. I mean, we've had a bunch of clients, send in money they had sitting in the bank because, when these things happen, typically your pendulum swings too far. So right now the market, or at the end of last year, the market swung too far towards overpriced. Now I would expect it to swing too far towards underpriced. So if we're lucky, we'll get some real good deals here in the coming months. You can tell also by looking at the headlines. The headlines are doom and gloom, doom and gloom. Well, who's publishing that stuff? The hedge funds. What are they doing? They're shorting the markets. And then once people freak out enough and they've wiped out the retail traders, then they buy back in and make a ton of profit. So
yeah, this really is a good opportunity for those with cash. I mean, they may feel safe, but anyone who's sitting on cash this year is still losing 8, right?
Well, that's a great point though. How many years when people said they had additional cash that we'd say, gosh, just keep it, right?
yeah.
Rates were so low, I could get you a bond paying 1.5% if you wanted to save. Well, guess what? By proxy, what the Fed has done, interest rates have gone way up. They've gone up way too quickly. As we said, part of the reasons people think we might be near the bottom, again, not saying it is, but we priced in almost this entire year's worth of rate increases. I was talking to someone today. Right now, you could go out and get a 2024 hybrid that's between a corporate and a junk bond, maybe getting you 4.5%. I mean, just literally 6 months ago to 3 months ago, that was paying you 2%. So interest rates have gone up. You can get 1-year treasuries paying you 2.25%. I mean, so there's an opportunity right now to maybe not lose as much to inflation and get your money working for you a little bit.
Right.
Yeah, the 2024 high yields are paying 6.7 or something like that. I mean, that's been unheard of for years.
Right.
So.
Well, guys, thanks so much for your time today. I know we'll do this again. I know what did we just say? The Fed's going to come out and talk again, mid-June?
Yeah. It was
so
June.
Obviously the market will have continued volatility, but as we get closer to that meeting, we should expect some more volatility. And
remember, the experts, which are just guessing, are saying volatility through the summer. So let's get used to it.
Yeah. Anyway, folks, thanks for watching. If you have any questions that we didn't address today, feel free to reach out to us. You can find us at ironwoodfinancial.com. We're happy to chat with you about those questions or even your specific situation. So guys, good to see you as always. I will see you back in the office tomorrow. Have a great rest of the day.
All right, take care.
Bye.